The word investment is dominating Canadian debate. The recent budget talked about generational investments, $1 trillion over the next 5 years from the public sector, private sector, pension funds, and foreign investors, all designed to build Canada. But not all investment is created equal. And when it comes to foreign investment, or FDI, whether it benefits Canadians depends entirely on whether it's investment that builds or investment that buys, because those are two very different things. A great example of FDI that builds is the world's largest pea protein plant in Portage la Prairie, built by a French company called Roquette. Before, nothing but farmland. After, a state-of-the-art facility and hundreds of productive new jobs in food production, one of Canada's key strategic industries. For the investment to pay back, Roquette needs to grow, which is good for both GDP and local economic resilience. This is what most people imagine when they hear FDI. Foreign capital and know-how building something new and innovative here in Canada. Now let's talk about FDI that buys. The federal government recently approved the acquisition of Calgary-based Parkland Corporation by Sunoco, an American company. Parkland owns more of Canada's gas distribution infrastructure than anyone else, and a key refinery in Burnaby, BC. Sunoco isn't proposing to build anything new. All of the money coming in is going to pay existing shareholders for their shares. For their investment to pay back, Sunoco doesn't need to grow. They need to cut. They promised $250 million in savings from synergies, which means job losses. In fact, there are already reports of layoffs in Calgary. This kind of FDI doesn't add to the economy. It just changes who owns it. Parkland was a profitable and proud Canadian company that didn't need to be bought. Now, it's a branch plant of an American company. This is important. In the last decade, foreign capital has spent almost $200 billion buying Canadian companies, but less than $150 billion actually building in Canada. And in the decade before that, iconic Canadian companies like Inco, Falconbridge, and Alcan were bought by foreign investors. All of them are shadows of their former selves. Tim Hortons too, with new ownership destroying both their reputation and the Turkey Bacon Club. Worst may be what happened to Ontario's ATI. It held about half of the world's market for computer graphics chips when it was bought by AMD in 2006. The Canadian office employs fewer people today than they did then, and the ATI name is long gone. Oh, and the company that held the other half of the market for graphics chips back in 2006? That's NVIDIA, who's worth over $4 trillion today. These results should not be surprising. In an acquisition, investment capital goes to shareholders and not to build. In some cases, it's even worse than that. As a branch plant, you're now competing with other jurisdictions for capital. And in fact, the debt incurred in the acquisition to buy the company will now crowd out capital for new investment. Jobs are often lost to the acquired company to justify the purchase price, and communities are left worse off. Look, a couple of years ago, you could argue that this is all just the cut and thrust of global finance in a deeply connected world. But the rules have changed. The US government is directly acquiring assets in other countries, including Canada. China has been doing it for years. Other countries are starting to block more foreign acquisitions. Everyone else seems to know that ownership matters. Canada can't be the last one sitting at the table, pretending the world hasn't changed, saying, bargains galore, let's make a deal. We can all agree that Canada needs to build, and we can all agree that building requires investment. And foreign investment that builds factories or infrastructure or research facilities can be part of the solution. But when Canada secures commitments for billions of dollars of investment from other countries all around the world, we need to ask, is it for building or is it for buying?